Hello and welcome to Indianomics. Financial markets are swinging between fears of high inflation and liquidity tightening to worries of recession to joys of continued strong economic performance, especially of the US economy. The Indian rupee too has fallen and risen with the strengthening and ebbing of the dollar. But now some real worries have emerged in India over the current account deficit, worries that the deficit may get as high as nearly 4% of the GDP this year. There is already a large fiscal deficit. To answer many questions about the global and the Indian economy, I have with me a rare scholar who is an expert on both, Barry Eichengreen, Professor of Economics and Political Science at the University of California at Berkeley. He's also Distinguished Professor at the NCAER in India and is currently visiting the NCAER. I'm grateful to NCAER for ensuring that we get this interview. Dr. Eichengreen, thank you very much indeed for joining us.
Good to be with you in these interesting times.
Interesting is right, sir. And I want to begin with your country, actually. The recent economic data in the US has been strong, and we have had some particularly hawkish statements from several Fed governors. They're talking about even 4% of Fed rates. How do you assess the inflation and the likely Fed trajectory?
Well, you started, Lafa, by saying that the recent data have been strong. They are softening a bit. There are growing signs that the US economy is decelerating. That's what the Fed has in mind. That's why it is raising rates to slow the growth of the economy and bring down inflation. My view is that the underlying rate of inflation, once you strip out energy and food prices, is around 5%, meaning that the Fed is going to have to raise rates above 5% in order to bring inflation down to its 2% target. I think, therefore, that the markets are still underestimating how much tightening is in the cards if we don't see a recession throwing the whole process off course.
Okay. So, Professor, what you're saying is that we could have a situation where the economy slows because of the Fed tightening, but inflation could still stay above. So there could be a few quarters where we could have continued, really slow growth, but a tightening Fed.
It's possible on current policy that the economy will continue to grow and inflation will hover in the 4 to 5% range through 2023. That would alarm the Fed and cause it to raise rates even faster than the markets currently expect. I regard that as a real possibility, so I worry that the markets will be negatively surprised, and that could conceivably tip the US economy into recession next year.
Fed governors Bullard and others have spoken up to 4%. You are speaking about even 5%. And as you say, the markets are completely unprepared for anything above maybe 3.7, 3.75. If this were to happen, can there be financial instabilities in some quarters, like, for instance, Bitcoin or even some highly valued frothy stocks?
We've already seen the correction of risk assets, Bitcoin, questionable tech stocks, and the like. And we're also seeing trouble in developing countries from Sri Lanka to Pakistan to others as a result of tightening global financial conditions. So we will see more troubles of that kind, whether the US tips into recession or continues to expand.
Okay. How would all this impact emerging markets? As you pointed out, there have already been some casualties. But if the Fed were to go above 4.5%, and it is accompanied by recession in, say, Europe, and maybe a deep slowdown in the US, how would it impact a country like India?
Well, I apologize for playing on the one hand, on the other hand, economist. But on the one hand, weaker global growth will mean lower energy prices, which will be a positive for an economy like India that imports a lot of energy. But other than that, we're talking not only about the US, but we're talking about recession in Europe, given the energy shock they are experiencing. We're talking about significantly slower growth in China as well. So I think weaker global growth, and not only weaker US growth, will be the dominant negative impulse affecting emerging markets like India, buffered modestly by lower energy costs.
Okay. Yes, that would be an advantage if crude were to fall. But actually, at the moment, we are battling a fairly serious trade deficit in India. The latest numbers in July have really scared us. And if we extrapolate the first 4 months to the full year, many of us are coming to a calculation of about 3.94% current account deficit. Do you think India has something to worry here?
Well, I think that current account problem has to be sorted out. And the way it is sorted out is by making Indian exports a bit more competitive on global markets and discouraging households and firms in India from purchasing so many imports. In other words, I'm arguing that the rupee exchange rate should be allowed to adjust downward even a little more than has been the case so far. India is not among the emerging markets that have seen the largest depreciations of their currencies. As a result of the Reserve Bank of India intervening in the market to limit the currency's depreciation, you are seeing that ballooning trade deficit. So the cause is that the exchange rate hasn't been allowed to depreciate, and the solution is to permit that depreciation to occur.
Okay. Point is taken, sir. You know, there was a lot of alarm in India when the rupee went to 80 rupees per dollar in late July. But what you're advising is that that is for the good of the economy, that we better get to perhaps 81 or 82.
Right. So 80 is not a magic number. It's a round number, but it's a little bit peculiar that commentators attach so much importance to 80. So where India is in a situation where it has to pick its poison, if you will. It has to pick between continued large trade deficit, if it supports the rupee, and a bit of additional inflation, other things equal, if it allows the rupee to depreciate and import prices to rise.
Okay. Well, following the July trade deficit numbers, Citibank economist, the India Economist, points out that actually this is happening not only because of a crude price or Indian imports. It's just that India is growing more aggressively, faster than the world. So we are consuming much more imports, and our ability to export is not much, partly because of recession in destination countries, and partly because our exports are not that important or don't have so much brand value. So, I mean, what do you think will the recipe? Is it enough to just allow the rupee to depreciate? Or do you think the Reserve Bank may have to actively slow down the pace of growth in India through rate hikes?
I'm hopeful that relative price adjustment, allowing the rupee to depreciate, will switch demand toward domestic goods, supporting growth and limiting the trade deficit. And it won't be necessary to crunch the economy with higher interest rates that depress investment and slow growth. That would be the other approach. I think that would be undesirable. Try the relative price adjustment through rupee depreciation first.
Okay. Well, yeah, we hope so too, that it won't come to it. But once again, the July trade deficit is a bit worrying. Let me come to the India growth story now. That's where I really want your comments, since you are a long-term observer, and especially with the NCAR, you have done seminal work. One worry appears to be the fall in savings rate. There have been some idiosyncratic reasons. That there was demonetization, which disturbed the savings rate or showed an increase in deposits. COVID led to a sudden increase in savings, and then we saw liabilities of households also increase later on. But it looks like if you average out, the savings rate of the last decade is lower than the savings rate of the first decade of the current century. Is that a worry?
For me, that is one of the big worries. If I compare India growing at 7 or 8%, with East Asian countries that in earlier decades grew by 7 or 8%. The big difference between India and its predecessors in East Asia is they had much higher savings rates, so they could finance investment at home to keep that growth going. So you cited idiosyncratic factors like demonetization and COVID as explanations for the disappointingly low savings rate, but this is a longer-lived phenomenon. So I think the authorities need to do more in terms of being sure that households have attractive interest rates on their savings. They need to use tax policy to encourage savings. I think that will be an important part of the recipe for keeping Indian growth going.
Okay. Well, actually, just recently I spoke with a former RBI governor and economist, Dr. Y.V. Reddy, and he pointed out to this possible peaking off of savings and that reducing potential growth of the country. For us, the dream is to get to the 7 to 8% growth because there's so much of poverty to be resolved. You think that's under threat in the current decade?
I think the threat to maintaining 7, 8, 9% growth is on the savings side, as we've said. If India invests more than it saves, it has to borrow abroad in order to make up the difference. It can borrow in a relatively benign fashion by attracting direct foreign investment, or it can borrow on global bond markets. India hasn't done such a great job at attracting foreign direct investment, and we know from experience that borrowing on global bond markets is risky. It can come back and bite you if the global cycle turns. So I do worry about the savings constraint on growth.
To be fair, the government seems to be cognizant of not wanting to borrow through dollar bonds. A proposal was struck down about 3-4 years ago. But they are pinning their hopes on this PLI scheme, which is, preferential incentives for investing in India. They're hoping to attract the China plus one, kind of investors. Do you think that PLI scheme can succeed to bring in FDI?
Well, I think that broader business-friendly reforms, both substance and image, need to be changed to make India a more attractive destination for investment. So there is an image problem that it takes many more days to establish a business in India than in Vietnam. And there's a reality problem and there is an image problem, both. So I think it's not simply tax incentives and the like, but streamlining bureaucracy that foreign investors will look to.
Okay, streamlining bureaucracy. Dr. Reddy spoke about even police and judicial reforms to ensure actually even economic growth. But at the moment, what do you place the Indian growth story as? Would you say it's good to go at least up to 6.5% in the decade?
Well, a decade is a long time.
Yes.
For the moment, India is pretty much the fastest growing economy on the planet. And having suffered a difficult COVID, there is scope now to bounce back. But the issue is to keep it going, to boost the investment rate and to finance that investment at home. So will that be done or not? I have only been here for a few days, but I've heard a lot of talk about debate around structural reform and whether the government and the public still have an appetite for structural reform. Having that appetite and following through, I think, will be important if when you think about the prospects of keeping growth going for as long as a decade.
Okay. Professor Eichengreen, I have a couple of more questions on the India growth story, especially the performance of human development indices and whether that will impact the secular growth story. But also, you've done seminal work on central bank digital currencies. Those two issues in a minute after this break. Welcome back. We've been speaking with Dr. Barry Eichengreen, Professor of Economics from the University of California at Berkeley and Distinguished Professor at the NCAR. Dr. Eichengreen, thank you very much for your patience. Well, I want to ask you two sets of questions. One is there any immediate threat from the large fiscal deficit, almost touching 10% if you count center and states, and the current account deficit at 4%, considering that you're expecting a steep rise in US rates? Should we worry about these twin deficits immediately?
I think you should start worrying about them immediately. Okay. In other words, I don't think that India faces an imminent fiscal and financial crisis. The government debt that is issued to finance the fiscal deficit can be placed with the state banks and with the financial system at home more broadly. But the problem is that if the banks are investing in government bonds, they're not going to be lending to business. And in the medium term, there is a drag on economic growth. So I think the fact that the deficits are large and they're adding to an already large public debt is going to be a drag on economic growth in India. People talk about whether there's going to be a financial crisis day after tomorrow. I don't think that's the risk or the problem, but I worry about crowding out business investment and in that way slowing economic growth. So it's important now to begin to figure out how to narrow those fiscal deficits and stop the growth of the debt to GDP ratio.
Yeah, we're coming back to that savings issue, isn't it? So no immediate crisis, but there can be a slow rot if we don't check this saving. Dr. Eichengreen, the other issue is, of course, the Human Development Index. While the Indian growth story is fairly consistent, on Human Development Indices, we are still scoring rather poorly. Will that come back to bite growth?
Growth depends heavily on human capital, on people and their capabilities. So I worry that still only a relatively small fraction of the Indian labor force has a university degree, which you pretty much need to have in order to become a coder, a serious employee in the digital sector. That a relatively small share by international standards of the Indian labor force has a high school degree, which you need in order to be a productive worker in manufacturing. In order to grow, India is going to have to grow the digital service sector and the manufacturing sector at the same time. And that means giving more people the relevant education and training. And if you compare India to the Southeast Asian economies or China, you see it lags behind on those scores.
Oh, yes. That's what, again, to hark back to Dr. Reddy, he said we shouldn't allow the demographic dividend to become a demographic disaster. Okay, Dr. Eichengreen, the most important question I wanted to ask you was about the dollar. You've spoken about the exorbitant privilege. Do you think the dollar hegemony, or the dollar's dominance, if you please, can continue? Do you see any dangers to it? It seems to have only strengthened.
Well, the dollar's dominance is being eroded on the margins. So if you look at the share of central banks' foreign reserves held in dollars, it's declined from 70% of the global total to 60% of the global total since the turn of the century. The surprise is that the slack has been taken up not by other big currencies like the euro and the renminbi, but by non-traditional reserve currencies like the Canadian dollar, the Australian dollar, the Korean won, etc. So I think we are moving slowly away from dollar dominance, just like we're seeing the United States very slowly account for a shrinking share of global GDP. It makes sense that the dollar's international role and the US role in the global economy should move together.
Okay. Now to come to the central bank digital currency. India is trying to develop one, but we've also developed very good payment systems. And there are agreements between India and Singapore and, India and UAE. There are agreements between Hong Kong and some Southeast Asian countries for cross-border payments on their domestic payment systems. Do you see a time when central bank digital currencies may sidestep the dollar and, money can be exchanged over international borders without having to go to the payment system in the US?
Well, we're already seeing some movement in that direction, more markets in currencies so that Mexican importers can buy Canadian dollars directly when they're importing maple syrup from Canada, rather than having to first buy US dollars in order to get their hands on Canadian dollars. And we're seeing similar market development in Asia. So I think there are a growing number of ways to sidestep the dollar. Central bank digital currencies are not needed in order to accomplish that. India has a universal payment system that everybody with a cell phone basically can use, right? So I don't think the making payments available, digital payments available to everyone in India through a central bank digital currency, I don't think that argument really applies, given that you have UPI and given that digital payments, existing digital payment systems can be linked across borders. I think the cross-border payments argument for central bank digital currencies is weak as well. So count me as a skeptic about whether the RBI needs to move down that road.
Just a final question on this. There was talk that you could work from the Indian payment system and directly pay probably your child in Singapore who's studying, or even a trader. There were plans that we would work towards that. You see that kind of things happening bilaterally?
I do, and we already see it happening between Singapore and Thailand, which have linked their instant payment systems, between Hong Kong and other economies in the region. So there's no reason why India couldn't be part of that process.
All that was perhaps efforts to sidestep the dollar in case sanctions became a big reality. It was in that context the conversation started. Professor Eichengreen, I've run out of time. Thank you very much indeed for joining me and speaking on a range of topics of interest to our viewers. Hope you have a good stay in India, and I want to thank NCAR as well for enabling us to have this interview.
Thank you.
That's it on this special show. Thank you very much for watching.